Ladies and gentlemen, Donald Trump has issued a strong warning, stating that we're heading towards something far worse than a simple recession. He believes we're on the brink of a massive economic transition, one that could change the economy, as we know it, and not for the better. As I'm recording this, the markets are looking volatile, with reports suggesting a sharp sell-off could hit on Monday. Bitcoin is sinking and new data is coming out that points towards something far worse than a recession, possibly a depression. In today's video, I'm going to dive deep into why things aren't looking good and how we can protect ourselves from what's coming. Let's get into it. It's shaping up to be a rough day for the stock market this coming Monday. Stock futures are falling, and we're seeing some of the biggest sell-offs since September of last year. A lot of this has been driven by ongoing trade tensions, especially between Donald Trump's administration and China. Just recently, Trump spoke about the possibility of a recession, but he warned it could be much worse, a transition period, where the economy struggles to adjust to a new reality. The only thing that's been keeping the global economy afloat has been massive government spending. But with governments all over the world deep in debt, the situation is becoming unsustainable. Investors are starting to question whether these governments can pay back their debts, and that's triggering a pullback in the markets. It's not just the US. This is a global problem. As for inflation, many central banks have said it's under control, but the reality is, consumers are feeling the pinch more than ever. Prices are rising month after month. Groceries, gas, and basic goods all seem to be getting more expensive. From what I'm seeing, inflation is actually getting worse now than it was even during 2022 and 2023. Each time I go to the store, it feels like the cost of everything has gone up 10 to 20% overnight. With inflation still eating away at our purchasing power, it's hard for people to believe that the economy is truly improving. Looking at Bitcoin right now, we see it's taken a major dip, falling below $81,000 at one point. While Bitcoin has been volatile, this drop is a clear signal of market uncertainty. Bitcoin is often considered a risk-on asset, meaning when people are feeling uncertain about the economy, they sell off riskier investments. This sell-off isn't limited to Bitcoin either. We're seeing the same pattern in tech stocks. As fear spreads and people start cutting back on their spending, it could set off a chain reaction that drags down the broader economy. If consumers pull back, it can make things much worse. Now let's talk about the job market. And this is where things get particularly troubling. You know the saying, when your neighbor loses their job, it's a recession. When you lose your job, it's a depression. Unfortunately, mass layoffs are becoming more common, and the numbers are higher than we've seen in a long time. In February alone, 72,000 layoffs were announced, marking a 45% increase compared to January. That's the highest number of job cuts since July 2020. And remember, July 2020 was the height of the global shutdown, which created a temporary economic collapse. But now, we're not dealing with a temporary lockdown. This is the real deal. Many of these layoffs are hitting both the private and public sectors, and these people who are losing their jobs are also the ones who spend money in local businesses, restaurants, and retail stores. Without that spending power, these businesses may face a tough road ahead. The GDP numbers aren't looking much better. The latest data shows that the U.S. economy is on track for negative GDP growth in the first quarter of this year. Initially, the Atlanta Fed estimated a small contraction of 1.5%, but as of March 3rd, they've updated that projection to a much steeper 2.8%. That's a huge decline. Even though it might not seem like much at first glance, a drop of 2.8% in GDP means massive job losses, decreased economic activity, and more pain for households across the country. This downturn is likely to deepen as more tariffs are imposed, geopolitical tensions rise, and global trade becomes more strained. When we look at the U.S. stock market in comparison to the rest of the world, the picture gets even worse. The S&P 500 is down 1.9% year-to-date, while European markets are up nearly 9%, and the Hang Seng Index has gained 20%. This indicates that investors are starting to see the U.S. market as overvalued, especially when you consider the underlying weakness in the economy. With uncertainty rising, global investors are seeking opportunities elsewhere, and it's becoming clear that the U.S. stock market might not be the safe bet it once was. Another concern is the weakening of the U.S. dollar. It's now almost 4% lower than its peak after the election, and it's continuing to lose ground. As the dollar falls, it signals growing concerns about the U.S. government's ability to handle its massive debt. Investors are losing confidence in the dollar, and that's pushing them to seek safer assets, which could further weaken the U.S. economy. If this continues, we could see more pressure on the global financial system. And then, there's China. Despite reports claiming their economy is booming, the reality is far different. China is facing severe economic challenges, including deflation. Their consumer prices have turned negative, marking the first time this has happened in over a year. While Beijing has been trying to stimulate the economy, the recovery is slow, and the overall situation isn't as rosy as many would have you believe. The global economy depends heavily on China's growth, and with their economic struggles, it's only going to make things harder for the rest of the world. So, what does all this mean for us in simple terms? It means that the government has been propping up the economy with massive spending, but that can't go on forever. Governments around the world are too deep in debt to continue spending at the same levels, and we're about to see a significant contraction. Layoffs will keep rising, stocks are overvalued, and inflation is still out of control. We could see a major market correction, potentially 20% to 30%, and a full-blown recession this year. Now, I know all of this sounds grim, but there's a way to protect your wealth. I've been consistent in my advice, and I'm still saying it. Gold is a solid hedge against economic downturns, and gold mining stocks could be a big opportunity right now. Gold prices are hitting all-time highs, and with geopolitical risks continuing to escalate, gold could be your best bet to preserve value. Right now, gold is trading around $2,120 an ounce, and it's getting closer to hitting $3,000. But here's the kicker. While gold itself is soaring, many gold mining stocks haven't kept pace. For example, Gold Mining Inc. (DARS GLDG) is trading near a 5-year low, even though gold prices are at record highs. Gold Mining Inc. has a strong portfolio of assets, including 12.5 million ounces of gold equivalent in measured and indicated resources, with more than 9 million additional ounces inferred. This company has cash, no debt, and a very experienced management team. Right now, their stock price is trading at a steep discount to its actual value, and this could be an opportunity to get in while prices are low. In conclusion, we're facing a very tough economic road ahead, but by staying informed and making smart investment choices such as in gold and gold mining stocks, you can protect your wealth. Do your research and keep an eye on the bigger picture. Thanks for watching, and I'll see you in the next video.